Hey everybody, welcome back to Milkshakes Markets Madness. My name is John Kutsmita. Every week I am joined by the man behind the dollar milkshake theory, Brent Johnson. Now, if you're unfamiliar with what the dollar milkshake theory is, I encourage you to go to our website, milkshakespod.com, or if you're on YouTube right now watching this video, or if you're listening to it, I encourage you to go to the YouTube channel. At the top of our channel, there is a playlist called Start Here. There's 3 videos. One describes and goes into what the dollar milkshake theory is. It's a presentation by Brent. The second video is about the Eurodollar market. And the third video talks about some of the geopolitics and the relationships globally with the global financial system and its dependency on US dollars, which is a big part of the themes and topics that we cover here. Speaking of Eurodollar markets, we do get into an interesting discussion about that relationship with outside markets and the US dollar. Before we do that, we talk about Twitter, DeSantis and his presidential campaign announcement. We get into a little chat about social media and how everyone nowadays has the opportunity to grow their brand with social media. That was kind of a fun chat. The latter part of the conversations where we get into financial markets, the Eurodollar markets, and we also talk about some of the things that are going on in the tech space, in particular what just happened last week with NVIDIA, its huge earnings beat, and a lot of the market reaction or froth around that. Brent shares his thoughts on that, whether he thinks it can continue, and potentially the risks if it does not. So there's a little bit of everything in here for the broader audience that we have. You want to jump around, we always have timestamps in our video, so check the show notes to see that. Otherwise, let's get started. Welcome back to another episode of Milkshakes Markets Madness.
Please speak as you might to a young child or a golden retriever.
I drink your milkshake.
Hey Brent, welcome back, man. How was your week? Another day in the maddening world of markets?
It's been good. It's been fun around here. My son graduated from 8th grade yesterday, and now he's got 8th grade prom tonight. So, you know, I didn't have an 8th grade graduation, and I certainly didn't have an 8th grade prom. So life's a little different for my son than it was for me, but all good.
Does it feel a bit like, every grade they feel like they get a graduation? Does it feel almost a bit too much like a participation trophy event?
No, apparently here, it wasn't this place where I grew up, or this way where I grew up, but in Puerto Rico, apparently 8th grade graduations are kind of a big deal, and it's a kind of a big family affair. So it's been fun. I'm not complaining at all. It's just the dichotomy between the way he's grown up and the way I grew up is a bit different.
Well, I think we'll probably have a chance to develop that a little bit further as we talk about what's going on in tech in this conversation. But before we do that, and I guess there's a little bit of a tech piece because they had a tech snafu. On Twitter, we had the DeSantis Spaces event where he announced his presidential campaign. Did you get a chance to tune into that or listen to a recording?
Yeah, no, I did. And it's funny because I didn't even realize it was going on. And then I just happened to log into Twitter because I'm never on Twitter, John. I'm never. But no, I was at my son's practice and I went on Twitter and I said, so then I started listening to it and I kept getting kicked off. And at first I was kind of annoyed. I thought I had bad reception or something. And then I went to regular Twitter and other people were making that's kind of amazing too, right? You could go to Twitter to see that Twitter isn't working. And I saw other people were having the same trouble. So I just, every couple minutes, I tried to go back in. And finally, after like 20 minutes, it seemed to work okay. But it was kind of funny to hear them kind of scrambling behind the scenes and the whispers and we've all been there, whether it's hosting a Zoom call or doing a recording like this. And, it just doesn't go exactly the way you want. And it's just so frustrating. But I guess ultimately it worked.
Yeah, and I think, it's not how they wanted it to go, but any news is good news. And someone like DeSantis, who I think everybody knew would eventually make an announcement to run for president, the announcement alone wasn't necessarily groundbreaking, but the fact that there was all these technical glitches and everybody in the mainstream media can't wait to dunk on Musk and his version of Twitter, I think it gave the story way more legs than it would have. And I believe Elon even made a comment to that. Everyone was trying to dunk on him. And he's like, this, I think his quote was, this was the biggest story on earth. So
Yeah, and to me, it's kind of funny. 15 years ago, was it 15 years ago? Almost 20 years ago now, when Obama ran, he used social media a lot. He didn't announce his candidacy on social media, but he used Twitter and he used other social media, and he was kind of hailed as kind of a revolutionary and very forward-thinking and a visionary for going directly to the people, kind of jumping around traditional media outlets. And I agree. At the time, it was very kind of interesting and new and visionary for Obama to have done that. So I think it's kind of interesting to see the change now, 15, 20 years down the road, that, whereas it was originally hailed as this cool thing, now the legacy media is like, wait a minute, you mean you're going around us? And, you don't go through the traditional channels. And of course, they immediately brand it as a negative thing, or right wing, or however you want to describe that. So I just find it all incredibly interesting. There's so much hypocrisy on both sides. We've discussed this before. And, if the roles were reversed and a Democrat had gone on, Twitter, and it had the same technical errors and it didn't work right, the Republicans would all be up in arms saying the same thing. Oh, look what a joke this was. So I kind of find the whole thing pretty funny, but I thought he actually did a good job, speaking to his base and speaking to his followers. And he had, I think there was almost 600,000 or 700,000 people were listening to the Spaces call. And then, the listening to the recording was, multiple millions or something. So, yeah, I mean, it's going to be very, very interesting to see, the showdown between DeSantis and Trump.
All right. Now, speaking of technology and some of the advancements or kind of this shift that we're seeing towards outside of legacy media, one of the things that I'm thinking about here that's a little different than perhaps the direction we would have took with this topic is, obviously you're a big fan of Twitter, you use it frequently. And I think before, ever since going back to really Google taking on or buying YouTube, I mean, you look at the influence that Google has had as far as a media giant, and then the Facebooks and whatnot. So social media, the impact is so well known at this point. But there is still, I don't know if it's a demographic thing, but there is still obviously a generation that's still holding on to television and getting their news from traditional media. Now, with that aside, your own personal professional career has kind of been an interesting one in terms of how you've been able to leverage social media. Now, you talked about the way Obama used it in his presidency. Do you ever look back in kind of the journey that you've had in your career and think, wow, what a hill or mountain I would have had to try to climb had I not embraced Twitter? Certainly the way you use it's very unique. You embrace both the lovers and the haters. But certainly getting your message out there, you're on a lot of different YouTube shows. Do you ever think like how, I don't know if in your case, you're ahead of the curve, or you struck lightning at the right time?
Yeah, I think it's a little bit of both. And the interesting thing is, I didn't start out on social media with the idea that I was going to have it help me grow my business. It certainly has ended up that way, no question about it. And it would be silly to try to deny that. But I really just did it for fun, and because I found it interesting, and I found a lot of good information on it. And then it just so happened that I had something to say, and I started saying it, and people started either agreeing with me or disagreeing with me, and it kind of took off from there. But I think it is kind of fascinating that there are so many ways to kind of self-publish now, right? That didn't exist just 10 years ago, and certainly not 20 years ago. And I would say that, 10 or 20 years ago, if you had a position like mine and you were trying to increase your profile, for lack of a better way of saying it, it was really hard. You typically had to kind of be a more senior person. You had to be somebody with a lot of experience. And then maybe by some stroke of luck, you would get invited on a TV show or a radio program, or maybe some, print media company would call you and ask you for a quote, and maybe you would get a little bit more well-known that way. But now I kind of feel like if you're somebody who has a point of view, there's multiple channels where you can put that point of view out there. And I think if you put out good work, people will find you, because people are constantly searching for things that they're interested in. Maybe it's the best way. Maybe you're the best taco maker in the world, right? And you have a special way of making tacos. I guarantee you, if you start a YouTube channel and all you do is make tacos on that YouTube channel, and you're really good at it, somebody will find you. And just because everybody's not only are there's all these avenues for self-publish, but people are searching for content, constantly searching for content. And so to me, it has been a really rather fascinating journey, to be honest, because I didn't set out this with this plan. It's kind of happened, and I've kind of enjoyed it and kind of embraced it. But I didn't set out to do this. But once I saw the ball start rolling, I certainly embraced it.
Yeah, I wonder how many people get thoroughly disappointed when they're searching for milkshake recipes and find our show.
Right, yeah.
Who are these two knuckleheads, and where's the milkshakes? So while we're on this vein, the shutdowns and the response to COVID in 2020 really accelerated some of this, because now everybody was thrown into a place where they had to get a microphone and they had to get a camera, and suddenly there was an empathy for not only the process, but also when quality wasn't that great. And then suddenly it birthed this. Everybody now has, like you're saying, everyone had a voice before, but now they're suddenly comfortable with putting it out there because the expectation for how polished it is, it didn't need to look like, a CNBC or Bloomberg piece. Right. How have you, not that, again, this is something you sit and ponder deeply, but have you thought about the journey that COVID has, added to this process of people in our space and social media?
No question. I'll give you a perfect example. Like George Gammon is a perfect example. So George is a guy, I think most people that watch us probably know who George Gammon is. And if they don't, I would encourage them to find George Gammon's, Rebel Capitalist podcast and his YouTube channel. But he was a guy that used to go to investment conferences just because he was very interested in, macro and finance. And so he had to go through the traditional channels, right? He had to go to conferences to hear people speak, or he had to seek them out. He had to buy books. And then he met me and he met a couple other people at these conferences that he went to. And then when COVID started, and everybody was forced to be at home. What he decided to do was he said he was just going to start calling people and talk to them, and he would record it and put it on YouTube. And I don't think his plan was to create this big juggernaut, financial media business, but it's kind of become that. I was either his first or his second guest. I remember he called me up and he said, "Hey, we're all stuck at home. I like talking macro. Would you come on and talk with me?" And I said, "Yeah, of course." And since then, he's built it into kind of a big online brand and business. And now he hosts conference in person, and he's kind of become a person in the macro world. And it's really an outcome of his interest in the topic and his willingness to put himself out there and publish his own work and his own, interactions with other people. So, I think and I think to your point, I think it's a very good one, is I think if everybody could produce like super high quality content like CNN or Fox News or whatever it is, that would be preferable. Of course, everybody wants to look the best, but because everybody has now used Zoom or WebEx or, some Riverside, some kind of a host, or put something up on YouTube, and they realize the challenges that go into it, and they realize that not everything is absolutely perfect, then they're much more forgiving when they watch somebody else's and it's not absolutely perfect. And again, I think, everybody wants it to look beautiful and be perfect, but as long as you're putting out quality information, people will come find you. If you wrote a handwritten letter and just, Xeroxed them and then posted them to YouTube and just page after page, and it was really good, somebody would find value in it. So as long as it's really good work, like if you're making predictions and they're coming true, or if you're providing information that nobody else has and it's helpful, they will come to it. Now, it's obviously better if it looks good and it's snazzy and it's got, the branding, but as long as the quality is good, then I think people will gravitate towards it.
Brent Johnson, the social media marketing guru, with his insights into how to produce content for YouTube. Yeah, maybe you can do a tutorial on how we produce this show. That'll be good. So, so
Because
speaking of,
I do all the work behind the scenes. All me.
so, so speaking of macro, let's make that pivot and perhaps in a broader topic, which is Eurodollar markets. Eurodollar markets and some of the things that we're seeing in global markets around the dollar and where the dollars are moving. In particular, we did have someone, a fan of the show, Nicholas, leave a comment on Twitter asking for you to discuss the possibility of the Eurodollar decoupling from the domestic US dollar and ultimately the Fed's influence over that. Do you want to jump into that as we start to get into markets a little bit?
Yeah, sure. So it's actually an incredibly prescient question, and it's a really deep. It's a deeper question than I think maybe people realize, because it kind of gets to the heart of what is money. And we don't have time to go too far down the rabbit hole, but the reality is that the Eurodollar market is kind of a secondary derivative market of the United States market. And I've talked about this before, and what makes the US dollar so powerful is the Eurodollar market. But because of the way the system is designed, money has to circulate. If it doesn't circulate, interest doesn't get paid, defaults start to happen, and it starts a chain reaction where really, you get a credit contraction and you get a collapse of the system. And so based on that, there has to be a central bank. Based on the design of the system, there has to be a central bank that can go in that situation and recollateralize the system. In other words, put new base money into the system as the system starts to delever. The problem with the Eurodollar market is there is no entity that can recollateralize the system that is not a US entity. And so the only way that the Eurodollar market can continue to function is for it to continue to grow. And if it does not grow, the only way for it to continue to function is if the US, some entity in the US, creates base money that the Eurodollar market has access to. And this may be a little bit too technical for somebody who's not familiar with how the system is designed, but I've done some previous presentations that kind of walk through this in a little bit more detail. And so could we get to a situation where the Eurodollar market decouples from the US domestic dollar market? The challenge is this base money. So the analogy I've used before is, imagine a game of musical chairs, and imagine there's 10 chairs in the middle of the room and there's 100 people circling around those 10 chairs. Those 10 chairs are the base money, and the base money is reserves at the Fed and physical currency and coins. That's money that actually exists. Okay, all of the 100 people that are circling around it, they are also money, but they have been loaned into existence. Though it has gone from being 10 chairs to 100 through the process of granting loans or extending credit. And when the music stops, all of that money that's loaned into existence starts scrambling for the only money that actually exists in physical form, which is the base money. So they go scrambling for those chairs. The Eurodollar market, imagine this US dollar market is happening inside of a room, okay? And those 100 people are circling around the chairs in a room. The Eurodollar market is in another room that encircles that room. And they're circling around the room, but they don't even have direct access, or for the most part don't have direct access to the chairs. And so when the music stops, they have to climb the walls and bust down the doors to get in there to get the chairs. So the only way for it to decouple and not have to have access to those chairs is if somehow they could figure out a way that it would always grow, right? And I don't think we've figured that out yet. Or they would have some entity outside of the United States would have to say, okay, we are now going to back all of that money that's been loaned into existence, and we are going to provide the base money for that system. And then on top of that, everybody who had already taken out that credit or was holding those credits would have to agree that they would accept that new collateral from that new issuer as the underlying collateral rather than dollars. And so I won't sit here and say it's impossible to happen, but in my opinion, it's impossible to happen without a bit of chaos in the process. And I think the likelihood of it happening is extremely small. Now, I'm not going to sit here and say that the U.S. might not stop providing that collateral to the rest of the world. And that's what kind of puts them in the driver's seat is, the rest of the world, they've extended all these loans and all this collateral, but they've done so under the assumption that the United States is going to continue to provide the collateral for the world. If they don't, that puts the rest of the world in a really tough spot. And that's kind of what we saw last year. And that's why I say, when the U.S. raises rates and it makes dollars harder to get, it's because they don't have access to as many dollars as they did before. And it becomes a big, big problem for the rest of the world. And so as a result of the United States government controlling that U.S. dollar supply, it lets them wield the dollar as a sword. And it's probably the most powerful weapon that the United States has. Out of all the weapons that they have, in my opinion, it is the most powerful because it's all encompassing. It doesn't just affect one part of the world. If you drop a bomb in Yugoslavia or Serbia or wherever it is, it's awful, and it would affect the rest of the world in some way or another. But it doesn't blow up somebody down in South Africa or somebody in Australia. But if you take rates to 10% and stop exporting dollars to the rest of the world, it affects the whole world. And so to me, it does it in a way that most people don't understand. To me, it's almost like a stealth weapon. The people who study finance and understand how the system works, they get it. But the average person walking down the street in, Oklahoma City probably has no idea what the Eurodollar market is and why that affects them. Or in Adelaide, Australia, right? Or in Durban, South Africa. They're just going on with their normal life, trying to, get to the end of the day and into the week and go have a beer on the weekend. I mean, they don't understand that the Federal Reserve raising rates affects their job halfway around the world, but it does.
So I didn't think we'd go down this rabbit hole, but the analogy was strong enough that I kind of want to poke at it a little bit in that we have this debt ceiling conversation that's been going on for so long. You've been vocal about how, generally speaking, it's just a circus. But it does feel like the circus is coming to a head here. We're going into a 3-day Memorial Day weekend in the U.S. Maybe on the other end of that, there's a resolution. You've talked about in various forums where no matter what they kind of decide short term, it's probably bullish for the dollar. Now, when you're talking about these Eurodollar markets and you're talking about the impact, whether it's even intentionally weaponized or not, the impact the dollar has on global markets, just because the Fed is doing its own monetary policy with its own dual mandate and its own objectives here in the US. But you have markets like Turkey that are now creeping into the headlines again because they're having issues and I think they're getting dollar swap lines from other countries. So it's so it kind of goes into your analogy. Now, if in the event the solution is that maybe even the US themselves or the Fed or the Treasury end up providing more base money to this periphery, this Eurodollar market, how do you think, is it another one of those similar to the debt ceiling situation where in both instances, whether they retract base money or add more to the system to help out the Eurodollar market, in both cases, do you see those bullish for the dollar, at least short term?
Well, in general, if the U.S. were to start extending swap lines, and so if you remember back in March, they kind of made this announcement that they went from 30-day swap lines to 7-day swap lines, and then I think maybe even overnight swap lines. I can't remember the exact tenor. But in that scenario, they did it because there was a fear of a dollar shortage. So they wanted to make sure there was enough dollars available. Initially, typically when the U.S. starts extending swap lines and those swap lines get drawn down, in other words, those countries take those swap lines. And I should say, this is still going to start to get confusing. I'm going to back up a little bit. When the U.S. does this, they're not giving the rest of the world base money. They're extending them a loan. So in that case, it's the Fed extending a loan to the ECB, to the Bank of Japan, Royal Bank of Australia, whatever it is. And so when they provide that additional liquidity, that would typically be negative for the dollar. The reason that they would need to provide those swap lines in the first place is because the dollar would probably be getting stronger because of the shortage of it. So the extending of the swap lines is probably negative for the dollar, but it's in response to the strength of the dollar, if that makes sense. And so if they came out and did that, I would expect the dollar to probably initially fall. But to me, it's just what it does is whenever the U.S. extends a swap line, all it does is reinforce the U.S. dollar as the global reserve currency, because it's just extending more U.S. dollar debt that the rest of the world has to pay. And so, it's why I've been so steadfast and been so, have such high conviction that regardless what happens in the short term, the dollar is going to end up rising again. And it's the understanding of how this works is why, even though after COVID, when they came out and they extended these swap lines and they did all this QE, I said, listen, it's just a matter of time before the dollar goes up again. And that's what we had. And now the dollar's pulled back. And in my opinion, it's just a matter of time before the dollar goes up again, because all of the moves that have been done to try to help solve these US dollar issues, all they actually do is create more demand for the dollar, which is kind of oxymoronic, if that's the right way to say it, or counterintuitive, but that's kind of the way it works.
So,
and if you think about it, sorry, let me make one more point. And if you think about it, why would the U.S. do something that would hurt the dollar long term, right? Why would the U.S. help out the rest of the world in a manner that would not ultimately serve them, right? I understand helping them out in the short term may be bad for the dollar, but why would the U.S. do something for the rest of the world that would ultimately bring down the U.S.? You think about it, it just doesn't make sense.
Now, with the debt ceiling coming up and the potential that once something's resolved, they're going to issue a lot of debt. When you're talking about these swap lines, is there a particular collateral that these other nation states or those who have access to the swap lines need to pledge? And do you think that, there are two different stories, weak dollar, increased debt distribution from the Treasury? Where do you think the resolution in the debt ceiling ultimately means for, say, Treasury yields and what the Fed is trying to do in terms of curbing inflation?
Yeah, so there's kind of two different things right here. So to get a swap line, what has to happen is the other country swaps their currency for US dollars. So these other countries, they have an account at the Fed, and the US will deposit dollars, for lack of a better way of saying it, in those countries' accounts. At the same time, those countries will deposit their own currency in an account for the Fed at their central bank. And so the U.S., they can take, they haven't had to do it, but let's just use the euro for an example, right? We give Europe, I don't know, $1 billion of US dollars, and they give us $1 billion equivalent of euros. And where does the other country get that money? They print it, right? So, I mean, that's newly created money that those countries are depositing with these. So the point is that when the U.S. quote unquote prints more dollars to give to the rest of the world is printing more of their currency to give to the U.S. And then those have to be swapped back, a week later, 30 days later, whatever, and with an interest rate. So those countries have to pay the U.S. an interest rate. They have to pay more back than that they've borrowed, and that's how the U.S. actually makes money on the deal. And so initially, like I said, doing that probably would be negative for the dollar. But as they raise rates, as we get into this debt ceiling, if this debt ceiling issue were to happen in a way that they did not solve it, I think there would be a lack of dollars in the system and yields would collapse because people would be rushing to buy any dollar or any dollar derivative of any kind, and that would push the price of those bonds higher and it push the yields lower. If they do come to a resolution, which I think that they will, then the Treasury, sometimes you get these terms messed up, the Treasury is going to go back out there and they're going to start issuing bonds. And I know people will say, well, the Fed will, where does the Treasury get this? So when the Treasury sells the bonds, they get money in return. Well, where does the money come from? The money comes from the market. So they're draining money that's already in the economy and they're draining it from there and putting it in their account at the Fed. And I know there's people out there who just can't believe that the U.S. is not printing money right now, but they're not. They're not printing money right now. So the money that's going into the TGA account, it's not QE money. This is money that's coming out of your pockets, my pockets, or anybody else's pockets who is buying treasury bonds. And I know there's many people out there say, oh, well, who would buy a treasury bond? Well, you know what? Every treasury auction has been oversubscribed, and the majority of the people that are buying them are from overseas. So this idea that the world is going to, start a strike on treasury bonds, it's a great theory, but it just hasn't happened. And this with the debt ceiling looming, they seem to want U.S. bonds more than ever. So I would expect as the debt ceiling gets as it gets resolved and they start issuing more bonds, and the Fed raises rates, I would think until we hit the wall and the economy contracts, I would think that yields will actually rise. So, but we'll see what happens.
So we've talked about a couple things where the theme is there's an action and then this reaction. Oftentimes people don't think about the reaction broadly enough, and they get focused on one particular thing. Now, one of the things with a similar theme in mind is what we've been seeing for the most part all year in, let's say, the NASDAQ, but in tech overall. But even just recently with NVIDIA and this huge run up. And I mean, granted, they massively beat expectations and all these wonderful things as a company. But then as far as like the multiples that people are applying to that when they're buying a stock like this at these prices, and really just tech across the board, is this an overreaction to some of these actions? Where do you think is it getting too frothy now that the fact that just today, for example, we had PCE come out, and that personal consumption expenditure was slightly hotter, and Fed, does like to look at PCE. Durable goods beat expectations, and just spending overall has been much higher than expected. So the economy seems somewhat still to be red hot, and tech has been more or less a barometer of animal spirits. So it seems like the Fed is going to keep being hawkish and keep hiking, and maybe there's not enough emphasis on what that ultimate reaction should be to those actions.
Yeah, so I think it's been really interesting, especially just the last couple of days, because as you and I have discussed really all year, or at least since the end of January to the end of February, it was like, or since the end of January, we've been going violently sideways, right? Up and down and back and forth and back and forth, and that is still true for the Russell, for the S&P, and for the Dow. But for the NASDAQ finally this week or even last week kind of broke out to the top of that violently sideways. And the NASDAQ's up 35% for the year. I think it was up 7 or 8% this week alone, and I think it was up 5% in the last 2 days. And a lot of it has to do with NVIDIA that you're talking about. And so I think a couple things are going on here. First of all, the reason I think tech has outperformed the more traditional U.S. Indices year to date is because of the expectation, the never-ending expectation that the Fed is going to pivot at any moment, right? Since last fall, when they kind of indicated that, they were going to continue raising rates, but probably not at the same pace, and that at some point in the future it would make sense to stop. Ever since that kind of language came out, everybody's started saying, yep, here it comes. The Fed's going to have to pivot. They're going to have to go to QE. They're going to have to cut rates. And so in many ways, every time there's been a little bit of piece of even slightly dovish data, the market has front run that and said, okay, now they're pivoting. They're going to go back down. And so technology tends to have an embedded interest rate play in it, because tech is typically where the only growth is at, or where the majority of the growth of an economy is in. And so as interest rates fall, and it's, it makes growth easier to happen. And so, technology will typically do well in that environment. And so as this interest rate expectations falling have increased over the last 6 months, tech has outperformed. And that made a lot of sense to me. But like for the last probably 4 to 6 weeks, to me, it's kind of been a handoff, because since then we've tended to get hawkish data. And despite the hawkish data, the markets have still it's funny, even it happened again this morning. They initially sold off, and then by the end of the day, things are up again. And I think it's because a little bit has to do with the debt ceiling. People are expecting the debt ceiling resolution. And so the market's getting a little bit of tailwind from that. But then I also think it's kind of this handoff to this new AI, phenomenon, this chat GPT. It's the high, and the AI is going to, create all this information at your fingertips, and it's going to cut down the need for skilled labor. And it's going to, take a lot of people out of the workforce, but it's going to make everything massively productive. And so this theme, it's funny because this theme has been around for 10 years, 20 years in some cases. AI actually isn't that new, but it's really kind of hit the forefront, this year. And when ChatGPT was launched, it's got the fastest adoption of any technology in history. I think 100 million users in, a month or 2 months or something like that. And then NVIDIA is the company that sells the chips that helps to power AI. And so they had blowout earnings yesterday, massively beat. And so, there's kind of this mania now for AI, and you got to get in on AI. And so, in my opinion, so that's why I think NASDAQ has kind of broken out to the upside. Now, whether it stays broken out is another question, because I think that in the very short term, maybe it goes a little bit higher. But to your question, is it getting ahead of itself? It kind of depends on your time frame. I'd say yes and no. So, when the internet came out, in the late 90s, a lot of people said, oh, you don't need it. This is overhyped. This run up in the tech stocks is ridiculous. And you know what? It ran up a lot for a couple of years, and then it crashed a lot. But then look where the internet's at now. It was pretty important, And, you could do the same thing with cell phones before that. And you can do, there's a number of different technologies where people initially said it's no big deal and then ended up taking over the world. And I don't know that AI is a complete game changer, but I do think it's important enough that you can't ignore it, and it's not going away. I mean, this genie's out of the bottle. It's kind of like crypto, right? Crypto, a lot of people said crypto wouldn't be around. And, crypto is still here, and it had massive adoption, and prices went up a lot. They corrected. They went up a lot again. And so I think we'll probably see something similar with this. So I think, maybe over the next couple of weeks, NASDAQ goes a little higher, NVIDIA goes a little higher. But I think by the end of June or end of July, that's probably having a correction. Maybe the correction lasts into the fall. And it's funny, before we started this, I sent something out on Twitter. I said, there is going to be a correction in the NASDAQ. There's going to be a correction in these semiconductor stocks, and there's going to be a correction in NVIDIA. The really, really tough thing is going to be, what do you do when that happens? Do you buy the dip, or do you just let it fall? And to be honest, I really don't know the answer to that. I think my inclination right now is to buy the dip. But the question is, how big is that dip, and when do you buy it? Because I do think, I actually think that in the years ahead, you've heard me talk about how I think U.S. equities are going to go a lot higher. And I think the big blue chip U.S. equities are going to be the main ones that go higher. But I think the big multi-cap technology names are going to go higher with them. Microsoft, Google, NVIDIA, all of these big tech companies, I think will do very well in the years ahead. But there could be some real ugly time between now and when we get to that. And I think we need to have some of this recent froth taken out of the market. The speed with which it's gone up typically doesn't end well, or there's typically some kind of a pullback along the way. And I think we'll get the same thing here.
Yeah, and the froth that you're talking about is also happening with very, very clear headwinds. This isn't, the stuff that was going on in 2020, 2021, like the narrative was massively bullish, and it was, all the memes about money printer go burr, and you had all of that happening to just inflate the narrative and this mania. Now I understand the reasoning behind when you see what AI, how exponentially it has grown in such a short time, and how useful it can be, especially across multiple channels. It's not just a chat bot where you ask it questions and it gives you feedback. I mean, some of the stuff that's going on in with Midjourney and the graphic design stuff and all of the things in that category of AI is fascinating. But this is still all happening with very clear economic headwinds, yeah, we do see healthy data coming in, but there's also other stuff going on underneath that's more forward looking, some of the manufacturing data, the shipping data. And then clearly the Fed is trying to keep things under a lid by being hawkish with their press appearances and continuing to do rate hikes. So it is a frothy one that I can see the case for why people think it's a good time to get in or why it can keep going, but it does feel like it's happening on its own amidst all these other friction points. And I think people, when we're talking about action and reaction, need to consider some of these other forces.
Yeah, I think that's exactly right. I was talking to somebody yesterday, the day before, and kind of the analogy I was using was that for the technology space and for the AI space right now, it's like you're skiing on just a beautiful day and there's like 5 inches of powder and the conditions are fantastic and you're having so much fun. But on the top of but it's been snowing for months, and on the top of the mountains you can see this huge buildup of snow. And it's just a matter of time before all of that snow comes rushing down the mountain in the form of an avalanche, right? And everybody can see it. This is not a secret. Everybody keeps looking at the avalanche and keeps warning people, get off the mountain, the avalanche is going to come down. But it hasn't come down yet. But just because everybody sees it doesn't mean it won't eventually come down, right? And so that's kind of how I see it. I mean, I think it's fine to understand that this is an emerging technology, and it's fine to understand that you need to have exposure to it, but by God, you have to pay attention to the avalanche or the potential for the avalanche. And maybe the avalanche won't come. That's the other thing. We don't know, right? I think it will, but we don't know. And so it makes it hard. It's a really difficult time right now.
Yeah, Surviving the Avalanche was an episode, or at least the title of an episode we did earlier in the year. And so here we are kind of circling some of these themes. And again, that's a lot of ways risk management. You come back to the same old truths and try to protect yourself from these outlying events that still have a probability of happening. And look, we have the debt ceiling thing. It's not resolved. People feel like it's getting closer. We've got a long weekend. We kind of touched on the AI. You said the crypto word, but we didn't really get into making a comparison between the two. So perhaps after this long weekend and going into next week, maybe some of this froth will come down. Maybe the debt ceiling will be resolved. Maybe we'll have another rate hike on the horizon, and we can get into potentially a deeper conversation about crypto and AI. But for now, Brent, that was a very thorough conversation. I appreciate all your insights. Anyone who's new to the show and you want to learn more, you can certainly do that at milkshakespod.com, but you can find us on YouTube, which is probably where you're watching this, which is our avatar is Milkshakes Pod. Now on there, you'll see we have different playlists, and the channel has a short playlist at the top that says Start Here. So if any of this is new, there's 3 videos there that I think will help you get acclimated, number 1, to what the dollar milkshake theory actually is and what it's saying, what the Eurodollar market is, and some of these other kinds of geopolitical relationships that we kind of discussed on today, but last week we got really into with the Santa Claus and prison analogies. So if you're new here, definitely go to the YouTube channel, check out that playlist. I think it'll indoctrinate you well into some of the themes that we're talking about. Otherwise, we appreciate everybody for coming on. You can find Brent on Twitter at Santiago AU Fund. You can find me at John Kutzmita. Brent, I appreciate you. Anything that you want to share with the community before we sign off?
Nope. Just thank you to everybody for listening. Have a great long weekend, and we'll see you next week.
This show is provided for entertainment and informational purposes only. It should not be relied upon as legal, business, investment, or tax advice. Neither the hosts, guests, nor any funds they may manage intends to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies.